Good afternoon, everybody. Uneducated Economist here. So be sure and hit that like button when you come into the live stream. By hitting the like button, the algorithm will pick up the video, spread it around for more people to join in, and it's a lot more fun to have more people joining in the comments section when we're doing these live streams. Like I said, it makes it a lot more fun. So today we're talking about whether or not the Federal Reserve is playing with fire, keeping the interest rates elevated, putting undue pressure on the economy, considering that we have inflation coming down and unemployment beginning to rise. And this is the recession indicator that a lot of people are talking about. And recently there has been a federal official, Claudia Sahm, who has the Sahm rule. That is an indication of whether or not the economy is moving towards recession. And to basically explain this simply, is when the 3-month unemployment average is 0.5% higher than the 12-month low. Does that kind of make sense? So when the 3-month average of unemployment rises 0.5 percentage point above the 12-month unemployment low, this is a recession indicator according to some. Now, a lot of people are looking at this and saying, yeah, this is it, man. When you have unemployment rising, this is going to bring employment down, or this is going to bring inflation down. And the Federal Reserve is now creating a situation that they are going to keep interest rates too elevated for too long, creating a painful experience to the economy that should not be there. And this is what a lot of people are talking about. Now, understanding from not just my point of view, right? Because I know a lot of times my point of view and the opinions that I have don't necessarily jive with everybody else's. I totally get that, right? And that's the whole point of the channel, is to have discussions from different ideas. But it has come very clear to me in my theories and my understandings of monetary policy that the adjustment of interest rates was no longer an effective tool. And so when you have a Federal Reserve economist, somebody who works there, communicating in a way that has people believing that the Federal Reserve should be adjusting interest rates, this is adding to the propaganda. Remember, anything that you are seeing on a mainstream media article, any kind, if it's CNBC or Bloomberg or on TV or anywhere else, if it is a Federal Reserve authority, professional, somebody who works there, however you want to describe them, whether they're a president or an economist or somebody, if they are communicating through the mainstream media, that is the propaganda. We must be aware of that. Like, what is it that they are trying to communicate that they want the people to understand? Because the forward guidance, the credible threat, is guiding the markets. If people have this understanding that inflation is running rampant, or that the unemployment is moving up, or has some sort of belief that there is going to be a recessionary pressure coming into the future, they will then begin to act in accordance to that information. And if the Federal Reserve can communicate that they are going to stall out on rates, cut rates, maybe even raise rates, depending on what it is that they want the markets to believe, that's the communication they will put out there, and that is what will then be the monetary policy. The actual adjustment of interest rates doesn't work anymore. Now, I left another link down in the description, not only to the CNBC article, which is pure propaganda, remember that, but I also left a speech that Michelle Bowman, who is very influential at the Federal Reserve, voting member of the FOMC, talks a lot about monetary policy, has some pretty interesting things to say. Now, let's take it back a little bit and understand how it is that the Federal Reserve typically tries to work the economy when it comes to interest rate adjustments. Now, there was a long time ago, what the Federal Reserve would do is try to adjust the effective fund rate at the overnight lending rate at the big banks. And this is important to remember, because if they could adjust the overnight lending rate at the big banks, then every loan after that would essentially be a risky loan going off to you and me or businesses or somebody else, right? So when these big banks lend money to each other, that establishes where the base of the interest rates are going to be, the effective fund rate. So what the Federal Reserve used to operate in is something called a limited reserve system, where at the end of the day, some banks would be in need of reserves and some of them would have excess reserves. The ones who were in need of reserves, the ones who had excess reserves would lend them to the ones who were in need of reserves. That overnight lending rate was the effective fund rate. The Federal Reserve could then buy and sell treasuries, the reserves, off of these big banks in order to adjust those levels of reserves so that overnight lending rate would land within the effective fund rate that the Federal Reserve was attempting to shoot for. So when the Federal Reserve says, hey, the Fed funds rates are this, that's them just writing a number on the wall and saying, hey, this is what we're shooting for, okay? The effective fund rate is that overnight lending rate at the big banks. Now, something interesting has happened over the last few years, and since, COVID and even since the great financial crisis, but really more back to September of 2019, is that something very interesting had happened in that overnight lending rate back in September of 2019 had shot up to like 10%. The next day, if the banks were having to deal with this, would have pretty much been frozen, as nobody would be borrowing money at such a high rate since the overnight lending rate shot up so much. The Federal Reserve stepped in and said, hey, no way, right? We got a problem here. The government was doing a bunch of spending. You guys are loaded up on treasuries. There was a big tax payment that pulled the cash out, but there's a problem here. We get it. What we're going to do is, since there's not enough money out there and the liquidity out there to do the overnight lending, we're going to take those treasuries off of your hands and we're going to hand you a bunch of cash. This was the overnight repo. Remember the reverse repo, the non-QE QE? See, this is important to understand, and believe me, I'll get back to Sam here in just a second, right? But this is important to understand because it changed the way the Federal Reserve is then conducting themselves when it comes to establishing that Fed funds rate, the effective fund. Because now it's no longer at that big banks. When that day took place where there was not enough cash in the system and that the overnight lending shot up to 10%, the Fed stepped in with the reverse repo, started taking treasuries off of the big banks and handing them cash and doing this transaction every single day, providing the banks with all the liquidity that they needed. This non-QE QE then took the overnight lending rate away from the effective fund rate. Like, the overnight lending was no longer the effective fund rate. The effective fund rate had then moved over to that overnight, or to that repo transaction that the Federal Reserve was now conducting with these banks. This is really important to understand, right? I know it's really complicated for people who are trying to figure this out for the first time, but understanding that portion of things, right? That the Federal Reserve no longer had the ability to adjust interest rates within the banking system the way they typically could from that overnight lending rate. Now, the abundance of money within the system that was coming from the repo facility to try and push out there to the bank to keep them liquid created a situation in which that the Federal Reserve had to lower interest rates to zero. Right? This is when COVID was kicking in. This is when the major problems were happening with the freezing up of the economy. Everybody was getting told to stay home. Stimulus checks were coming out. This brought the interest rates down to zero. That right there made the Federal Reserve ineffective. Monetary policy had failed, right? That was it. It was done. So the adjustment of interest rates would no longer work at this point. Now, something very interesting was being communicated at the time from the Federal Reserve when this was taking place. Right? They knew a long time ago that the low unemployment would not create the inflationary scenario that most people would have anticipated taking place. See, they knew this from the great financial crisis. And in fact, if you go and you look at the speech that I leave down in the description, you're going to find this being stated. The committee indicated that it would not act preemptively to curb inflation based on the perception of the labor market tightness. Very interesting to think about, right? A lot of people said when the Federal Reserve kept interest rates too low for too long, creating the inflationary scenario that we were experiencing, that was typically what would take place from the Federal Reserve lowering interest rates. But something very interesting they had observed, that low unemployment did not create the inflationary scenario that they were looking for. And this is super important to understand, because when typically the Fed would lower interest rates, that lowering of interest rates would spark investment. Businesses would say, hey, I'm going to ramp it up. I'm going to buy more buildings, buy more equipment, and hire more people. That hiring of more people started increasing the labor market. The more people working is the more people consuming. The more people consuming starts creating the supply-demand imbalances, and you start to find the inflation scenario. That was so typical of the Federal Reserve. Same thing in the opposite. When they would raise rates, businesses would slow down, lay off, not hire, and then you would see unemployment begin to rise, less people working, less people consuming, less, when you have that less people consuming, the supply comes in more in line with the demand, right? You find equilibrium and the prices begin to come down. However, that didn't work for the Federal Reserve after the great financial crisis. They realized it. They took interest rates down to zero. Unemployment came down to historically low numbers. Obama bragged about it. Trump bragged about it. Everybody loved to brag about how the low unemployment, historically low unemployment numbers existed. But at the same time, they failed to produce the inflationary scenario that they were looking for. And I know a lot of people want to argue that there was plenty of inflation, but even during the Trump administration, Donald Trump was out there screaming, wanting to fire Jerome Powell because there was no inflation. There's no inflation. The Fed should be printing money. I was so annoyed by that. I was like, does anybody else hear this? Is anybody else going to remember this? That Donald Trump is saying this right now, because he's going to have to eat his words later when we have issues. And now we find that all the money printing created all this pain and everything from the people. Right? What is it that would have happened if we had followed Trump back in the day? Right? This is one of the most irritating things that I had found. All right. Now, think about something else that Michelle Bowman had said. And an apparent insensitivity of inflation to the low levels of unemployment. This is directly stated from the Federal Open Market Committee voting member of Michelle Bowman. An apparent insensitivity of inflation. The inflation doesn't care about the low levels of unemployment. This is what the Federal Reserve's major problem that they were experiencing back after the great financial crisis. They were looking for inflation. They needed it anywhere that they could get it. It was too low. Right? You don't believe it? Listen to John Williams and what he had to say back in 2018. Today we face an altogether different set of problems from a very low neutral interest rate. That is, the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. The Fed had a major problem. They could not find the inflationary scenario that they were looking for. That was interfering with their monetary policy. They had interest rates at zero. Everybody should have been working, and that should have created an inflationary scenario that was meeting the monetary policy goals. It didn't work. So now I have to ask, as everybody is freaking out about this SOM rule, everybody's saying that the 3-month average is now 0.5% higher than the 12-month low. This is a recessionary indicator. I have to ask the question, does employment even really matter anymore? See, if low unemployment didn't create the inflationary scenario that the Fed was looking for, would high unemployment create the deflationary one? I mean, if low unemployment can't create it, then why would high unemployment create it as well? It doesn't work that way. The interest rates are no longer an effective tool for monetary policy. If you don't believe it, just look at the housing market right now. They raised interest rates a while ago. The mortgage market shot up instantly as far as the interest rates, and the house prices have gone up. Exactly the opposite of what it should have done. Interest rates go up, prices come down. It didn't work. Interest rates went up and prices went up because the interest rate adjustments from the monetary policy coming from the Federal Reserve is not an effective tool. Period. End of story. It doesn't work. However, since nobody knows that, the perception of it does, and the people's reaction to the belief that there will be interest rate cuts or hikes going into the future, then actually participate within the economy in a way as if those rates cuts had happened. And that is the monetary policy. See, all this stuff that we're hearing about unemployment and all that, it doesn't matter. It doesn't change monetary policy any. The only thing that will change monetary policy is the perception that people have of what those interest rates are going to do going into the future. That is the impact to the economy. It's just, and I know this is so difficult for most people to wrap their heads around because they've never heard information like this. Like, everybody is still stuck in the old school classical monetary policy coming from the Federal Reserve where the interest rates go up, prices come down. That doesn't work. And if you can't see it, state it from their own words, not the words that they give to you through the propagandized CNBC and Bloomberg and stuff like that. I'm talking about the words that they use within their speeches that they communicate to the other bankers with. That is the communication that we should be paying attention to. The rest of it we have to pay attention to understand the monetary policy and what it is that they are trying to do. That's not the truth of the matter. This Psalm thing is a bunch of BS. The Federal Reserve does not look at unemployment as the recessionary or inflationary or deflationary, none of that stuff. It doesn't matter to them anymore. Not like it did. There was a time it was incredibly important, but not anymore, right? They already found out that hitting the lower bound of zero, monetary policy through the adjustment of interest rates was no longer an effective tool. However, since nobody knows it, they can communicate in a way that does conduct monetary policy through the belief of interest rate adjustments. It is the strangest situation we are in. I am really surprised that I have been able to figure it out since nobody else seems to talk about it, but this is the case. I have plenty of proof of it coming from their own statements, not the ones that I make up or trying to assume or something out there going on. That's not the case. This is literally their words. This is their strategy from their own statements. So, all right, guys, I rambled on a little long there. I'm sorry. We are 16 minutes into it, 367 people with 80 likes, 367 people. We should have far more likes there. Let's get it up to 200 likes here in the next 10 minutes. And I will be out here for at least another 15-20 minutes. All right, go hit that like button, everybody. Let's cruise up here and see some comments. Wow, look at all these comments. Great to see you. All right, thanks, Simon. Well, thank you, Brody. We got I feel like markets need a huge downward correction, but I'm not making any predictions. That's just what I feel like to me. Let's go. Yui may be the only commentator stating foreign countries, U.S. bondholders selling their U.S. bonds to raise USD. Are these planned sales or urgent? I would imagine that most of them are probably urgent. Like, why would you sell your bonds at a loss? That doesn't make any sense unless you were desperate. That's the only reason why you would do it. Like, you would not sell your bonds at a loss if you had to, unless you had to. And so if you have debts that are coming due that are due in dollars and you can't seem to find any dollars out there through the production means or services that you are providing, then you're going to have to figure out dollars from the sale of your stuff, which generally means your assets, and there's no better way of getting cash than to sell a treasury. It's instantly liquidatable. I can't even say it. Liquidated. There we go. And so you might have other ways of raising cash, like sell your gold or something else, but really there's no other better form of raising cash than to get rid of your treasuries. It's instantaneous. And so that's really what I feel going on. I mean, think about it. If the dollar was weak and nobody wanted it, then it wouldn't be strengthening, right? We're at 105 on the US dollar index. It's like something that I had predicted a long time ago, that you would actually see gold and the dollar rise together. And this is not my prediction, really. This came from listening to Brent Johnson and Jeff Snyder and stuff, and it was just like, yeah, that makes sense. Right? And all this other stuff that, gold is going to take over as a world reserve currency, or the BRICS are going to use gold for transactions or something like that. Yeah, no, like if you understood Gresham's law and Triffin's dilemma, that is not going to take place at all, right? But once you incorporate those ideas and you think, man, it's probably a good idea to load up on a bunch of gold and silver right now, right? I mean, not because countries are going to use it, but because that's the best way to protect yourself from a third-party claim. All right? There's nothing else out there that quite does it like it. Simon, does lower corporate tax rates help corporate employment? Seems like there's rolling layoffs regardless. Benny, there's an actual... It's like on a curve, like any other curve, right? So there's a point in which that you can tax and gain benefit from it, right? You tax the group, use that tax money to enhance the ability for more business, more opportunity, more things to take place out there, right? But then you eventually get it to a point where you tip over the scales, and now taxing is a burden on the corporation. They can't produce as much, and now their profits are diminishing, and there's less progress and build up, right? Less progression going on. And so there, it's not a matter of whether or not tax cuts or increases or something like that. It's a matter of where you are on that level of the bell curve. And since nobody knows exactly where that should be, I mean, I would imagine that you would recognize it after you've gone past the tipping point, So unemployment has no effect on inflation. Is that because there is an abundance of money in the system? No, it's because of what happened is that it's not necessarily that unemployment. I wouldn't necessarily that's the case, right? Because it does have a lot to do with it. I believe it has more, and you got to understand, there are so many, like you can't just say, well, it's the unemployment that does this, right? It's the unemployment in conjunction with all the rest of the parts and pieces that you have to look at. And now the main issue of all this, and the reason why the interest rate adjustments don't work, right? See, typically employment and unemployment would definitely impact the economy when it comes to the consumption and supply and demand issues that happen out there. But something very interesting had taken place with the Federal Reserve and their monetary policy, and this is probably one of the hardest things to wrap your head around because it's very rarely ever communicated out there, so you really have to internalize it for yourself, and that is to understand the neutral interest rate. Now, the neutral interest rate is neither accommodating nor restricting the economy. It's neutral. Nobody knows where neutral is. Now, if you just set a neutral interest rate aside for just a second, if you can wrap your head around it and you understand that, then you can set that aside for just a moment. And then understand that there's also a neutral unemployment rate. All right. Now, this neutral unemployment rate is really low, close to zero, along with the neutral interest rate. So now, how is it when you try to restrict the economy, right? When you have a really low neutral unemployment rate, meaning that if you were right here at this close to zero, that it doesn't impact the economy. So if you have low unemployment and it doesn't create the inflationary scenario that you are looking for, you have a problem. And that's what the Federal Reserve was facing way back in, even during the Obama administration, through the Trump administration. There's no inflation. The Fed should be printing money. We have the best job number in 60 years, right? This is the problem, was that low neutral interest rate, that low neutral unemployment rate. And so now this is the realization that the Federal Reserve had come to, that monetary policy through the interest rate adjustments was no longer going to work. Period. It just doesn't have the impact to the economy like a lot of people want it to. They can't help but to believe that the interest rate adjustments will impact the economy because of how much experience they have had with interest rates and interest rate adjustments. But they don't understand that the neutral interest rate or the neutral unemployment rate, two different numbers, cannot be seen, right? There is no place that you can go to on the internet to say, what is it today? That how these two numbers, these two low neutral interest rates and unemployment rate, made monetary policy from the Federal Reserve impossible for them to do through the traditional methods that everybody would expect coming from them. And I don't know how to communicate this any other way. So now we have to believe the idea that it's not the adjustment of interest rates, right? See, before, that's what we would believe. We have to believe that it's not that now. And we have to understand that nobody knows that. And by understanding that the rates don't do anything to the economy, but since nobody understands that, their belief of what those rates will do does impact the economy. In fact, they've talked about this. We did a speech not too long ago. If you want to go and join the channel, membership only video. It costs $1 a month to be part of the channel. You have access to all the membership videos. If you go and you take a look, we just recently covered one from Phillips Jefferson, is that his name? Right, who talked about this exact thing. And in that speech, they even address the idea that it doesn't really have anything to do with the interest rates, and that the communication about it has more power. In fact, it's the only power. See, this is what's so amazing to this whole understanding of this monetary theory, that there was a time, like if you could understand that there was a time when the Federal Reserve would not communicate anything to us, not to the markets, not to nobody. One day we would wake up and all of a sudden interest rates had moved. Didn't even realize that it was going to happen. Boom, it just happened. And then the markets had to react to it. The Federal Reserve and the monetary policy makers believed that a shock to the economy was the way that you adjusted monetary policy, that you actually had to shock the people into it. As time went on and they realized that if they could communicate some of their intentions going into the future, that they could actually create more power to the interest rate adjustments. As time went on and they used this skill more and more and started creating more ways of communicating, more ways of putting out the information, the plot, dot plot, all this stuff, they found that through these communication channels that they were actually able to conduct monetary policy in a more profound way than actually cutting rates. This is from their own statements they figured this out. However, if they told the people, if they told the other economists, if they told mainstream media, hey, go and tell people that the interest rates don't do it anymore, but our communications do, it would all fail immediately, right? So now what they do is they have the intentions of creating an adjustment in interest rates, and that intention then guides markets, period. That's it. Right? Once you recognize and you understand it, that it's not the employment anymore. It's not the unemployment. It's not the employment. It's not the interest rate adjustments. It's the belief of all that. It's literally down to a psyops game. The Fed is effing with our mind. I have done so many videos on this going back years now. And this is, again, this isn't me trying to make up some sort of weird concept that the Federal Reserve is talking about. Is directly from their own words, from their own statements. This is how I was able to figure it out, is by reading these speeches and these communications that they have with each other. The communications that they have with the mainstream media is propaganda, straight up. It is all there to guide the people's perceptions. Even this article talking about the SOM rule, the Fed knows that it doesn't matter anymore, right? The committee indicated that it would not act preemptively to curb inflation based on the perception of the labor market tightness. Right? It doesn't matter whether it's tight or loose. It doesn't matter. They're not going to do anything about the inflationary scenario based on unemployment numbers. It just doesn't matter. Right? Because of the apparent insensitivity of inflation to low levels of employment, they knew they had to figure out another way. All right. So unemployment has no effect. Nope. Not like it did. All right, Simon has cracked the code. Well done, and thank you for sharing. Yeah, absolutely. And I encourage everybody to join the channel, membership only. We're going to do a video tonight. That was the other thing I wanted to let you guys know. 6 o'clock Pacific time here. We're going to do a members only live stream. I was going to cover Michelle Bowman's talking about the digital ledger technology and how the Federal Reserve is going to, and we'll still cover that one at some point, but I think it's more important that I take it back to a previous speech that was given a couple of weeks ago talking about adjusting monetary policy through balance sheet adjustments. Now, this is another way, it's not interest rate adjustments, balance sheet adjustments, and how it is that the Federal Reserve could then adjust the asset purchases or maybe the roll-off of those assets, and how that will impact the economy, how it will impact people's perceptions of what it is that's going into the future, and how it is that they are going to conduct themselves when it comes to buying houses and starting businesses or investing going into the future. But understanding that the Federal Reserve is looking at balance sheet adjustments in order to conduct monetary policy, this is more powerful than the interest rate adjustments. And to understand what it is that they are feeling about that balance sheet adjustment and how to conduct monetary policy is very important for us. I mean, if you want to figure out how it is that you need to position yourself, what it is that you need to do going into the future, you need to understand what it is that monetary policy is really attempting to do. Because all these people out there who are saying that the Fed screwed up and don't know what they're doing and that they're playing with fire and all this other stuff have no idea of monetary policy strategies. because the monetary policy strategy is seeking to achieve an inflation that is moderately above 2% for some time. And nobody knows what moderately above 2% is. It's not indicated. There is no mathematical formula, and nobody knows what some time means, right? But however, everybody knows for sure that there is a 2% inflation target. It's BS. It doesn't exist. The Fed has already stated that they are not going for 2%. They're going for appropriate monetary policy being moderately above 2% for some time, with no indication of what moderately above 2% means, or some time, right? So now I understand that. I know it, right? Nobody else seems to know it. Everybody else seems to think that the Fed is going for some 2% target, which is not what they're doing, right? Not even close. Like 99.9% of the people out there believe that the Fed is going for a 2% target. They are not. They are going for an average inflation rate over time. In fact, they're going for something called flexible average inflation targeting. And if you really want to take it longer, it's asymmetric flexible average inflation targeting. If you want to be right down to the definition of the monetary policy that they are using, asymmetric asymmetric flexible average inflation target. AFAYET. AFAYET. All right. I'll miss tonight's live stream. Trackside. Oh, well, that's a bummer, deja vu, but that's okay. It'll be uploaded for you to go and check out later. All right. Where are all the military-aged males entering the U.S. going to find wives? Yeah. Damn, Yahoo Finance advanced charts are so laggy. The young is dead. The elderly won't reproduce. We're all gone. I agree, Wayne. You should become a member and support this guy. He's doing all us a favor. Yeah, thank you very much. I mean, I really appreciate you guys. We have 500, like, I don't know, 520 members to the channel now. I would really love to build this membership up to around 10,000. You get it up to 10,000 and I can, like, you know, drop my W-2 and pursue this information, pursue getting this information out, pursue other ways of being able to, you know, do courses, write books, do, you know, speaking engagements, lectures, stuff like that. That's really where I feel that my passion would be driving me, what it is that I could really do for, you know, something valuable for this world. And I find that would be it. By joining the channel, you would support the Uneducated Economist in that movement. It's $1 a month. It's literally $12 a year, $120 for a decade to support the Uneducated Economist and all this effort. And you get a lot of value out of it. Those membership-only videos are not things that you are going to find anywhere else. We are breaking down these Fed speeches word for word so that even the average everyday dude who's trying to get their heads wrapped around it can have a conversation and understand what's going on here. I feel this is very unique to this channel. This understanding of average inflation targeting, understanding that the unemployment doesn't work anymore, understanding that it's all about credible threats dating back all the way to Ben Bernanke's speech from 2002, understanding the Federal Reserve from their own monetary policy point of view and their communications to the other bankers is the way that we figure this stuff out. If you are listening to somebody who is talking about how the Federal Reserve screwed up, they don't know what they're doing, that they should have cut rates, they are missing it. They do not understand monetary policy strategies. They don't understand the neutral interest rate. They don't understand the neutral unemployment rate. These are things that we communicate, we talk about on a regular basis. Yeah, there is bad things out there. There is people out there who are trying to create a situation in which that is going to be very painful for you. Recognize it for what it is. Make them irrelevant in your life, and then push forward with what it is that you need for your life and your future. And you can do it by breaking this stuff down, understanding it for yourself, and then positioning yourself in a way that is best suited for you. Nobody, I don't care who they are on YouTube, I don't care who it is, how smart they are, or anything else, they have no clue of what it is that you have going on in your life. They don't know your debts, they don't know your goals, they don't know your, you know, your age, your expectations, your living standards. They don't know any of that stuff. Only you do, and only you can make the decisions for yourself. Understanding this stuff the way we do here on this channel just intuitively has you making the right decisions. Like, you don't even have to thinking about it anymore. It's just automatic to you. All right. Alrighty, guys, this was so much fun. I have about another 5 minutes. Is there any questions, anything that you want me to like recover, go back over again? reiterate or maybe just cover something? You have a question? Let's just cover that real quick and then we'll call it quits. Fed tools are worn out. Timing the market is a fool's errand, in which is what a lot of people are trying to do. Sorry. Finally made it to a live stream. Well, it's nice to see you, Spruce. Too bad we're coming to an end here in just a few minutes. Thoughts on this, Simon? Japan banking giant Nornenchucken to liquidate 63 billion in treasuries and European bonds to plug massive unrealized losses. Yeah, and I think that's probably, like, if you think about it, I don't think this is unexpected, right? I don't think this is an unexpected situation when it comes to the dumping of these treasuries. I mean, right now, if you think about what it is that the Federal Reserve and the Treasury are doing simultaneously this month, one of them is backing off on the unwinding of its balance sheet. So typically, the Federal Reserve would allow, what was it, $65 billion worth of treasuries to come off. Now it's only allowing 20. So they are keeping a lot of those treasuries from pouring out onto the market. That is going to make up for a lot of the other treasuries that these other nations are trying to unload, right? So as the Federal Reserve backs off on unloading them themselves, these other nations will have room to unload theirs. And at the exact same time, the U.S. Treasury has stated that they are in a bond buyback program. So if any part of that market becomes illiquid due to the people unloading these treasuries, right, if there's any moment in there in which that the issues start to arise, the Treasury itself will step up there with the liquidity and say, hey, man, we'll buy those bonds, right? This is both happening at the same time, planned from a long time ago. So this is not a surprise. This should not be a surprise to anybody. Like, it might be like a surprise that it's actually being stated, like we weren't expecting it from the news media, but it shouldn't be unexpected in that there's going to be nations who are facing liquidity issues going into the future, and that the Federal Reserve is going to have to do something about providing, or at least the Fed and the Treasury together are going to have to step up and do something to make sure that that Treasury market stays liquid. The moment that it becomes illiquid, the game is over, right? Like, that's it. And it's not like they don't know what's coming. So we know that they are planning on doing something, but because they can't tell us what those plans are, they can't tell us what those tools are. And the reason why they can't tell us is because the markets would begin to price those things in. So they have to believe that there is no other way that the Federal Reserve can do anything about the situation, considering all this treasury unloading that is happening. See, people, then it's like, oh God, what are they going to do? They're going to, whatever. Right? They have plans. They have plans to deal with liquidity issues. Think about it. When the banking crisis started to kick off, Silicon Valley Bank, everybody knew that there was a banking crisis coming. Everybody knew it. They talked about it. There was all kinds of YouTubers out there who are screaming their heads off, get your money out of the bank now before it's too late. There is liquidity issues coming. There's going to be bank failures. Everybody knew it. They were talking about it. They asked me about it. Are you going to get your money out of the bank? I said, no. And why? And I said, well, I probably should, but no, I'm not going to, because the Federal Reserve has lifeboats. And now I know that's a horrible way to look at it, but they already stated it. They said, hey, we're not going to let a banking crisis happen. We have tools that we can deploy. But they didn't say what they were. Silicon Valley Bank falls, bam, bank term funding program gets launched. Oh, nobody saw this coming. Well, no, of course not, because they can't tell you. But they did say, hey, we're going to have tools to deal with issues that are coming up. So it's not like, you think about it, guys. There's 150 plus economists that work at the Federal Reserve. These people have seen every piece of data that could ever possibly come out, and they know of all the historical theories and everything else that has always been there, right? These people know it. Now, how in the world can something slip past these people that all of a sudden everybody out here on YouTube could possibly see? Like, we can see it and they can't. Does that seem reasonable? Like, how can an uneducated economist talk on YouTube about something that the Federal Reserve couldn't possibly see? I don't think so. I'm not that smart. Now, I do believe that the Federal Reserve has positions in which that they cannot necessarily deal with due to the fact that they are limited on their somewhat of their capabilities of what it is they can do. But the unusual and exigent circumstances can change all that. All right. Anyway, guys, I gotta go. Thank you so much for joining the channel. Who do we have there? We got Detail Guy 317. You're going to really enjoy the live streams. They're boring. Like, I know they're boring. They're long. They take about an hour or so to get through, but the information that you get from it is top notch. Like, you will not get that information anywhere else. And again, this is the people not coming from like somebody else who has this misguided understanding of what monetary policy should be. This is coming directly from the people who are voting on monetary policy. Right? Very different, very different communications out there. All righty, everybody. Thank you so much for joining in on today's live stream. I got to call it quits. We are 39 minutes into it. We had 410 people watching with 199 likes. We are 1 like away from 200. We were supposed to get it up to 200, so go hit the like button, everybody. And if he hits 220, he stays live. I wish I could, but I got to go back to work, and so I just can't stick around for 220. As much as I would really like to. Credible threats, yeah? How does the Fed ever fail then? They aren't all knowing. They are smart, but not perfect. No, I totally agree, right? And I do believe that there will be a failure of the fiat currency at some point in the future. My point about it is that everybody who is saying this is how the Federal Reserve is going to fail, think about it. The Federal Reserve has already heard that too, and they are making plans accordingly to that. When Ben Bernanke, there's something, I'm just going to leave it right there. When Ben Bernanke came out and says, hey, we got this isolated to the subprime mortgages, it was bullshit. He knew he didn't. He knew they didn't. They had plans already set in place to deal with the fact that there was going to be a financial crisis within the mortgage market. They knew it. They would not have been able to deploy the things that they did if they did not already have the strategy for it, right? It was complete. Like, again, do not trust anything being stated on the mainstream media coming from the Federal Reserve. That is pure 100% propaganda used to guide the market's monetary policy, right? You cannot trust a single word. It is all about perception. It's all about a psychological game. Do not trust that stuff. You have to read it. You have to internalize it for the communication of what it is that they're trying to put out monetary policy, but it's not the real stuff, right? You got to understand it from the speech, from their own words. Look at it from that point of view, and then you can recognize the propaganda that is being spit out all over the mainstream media, right? I mean, I call it out. I pulled Time Magazine, I pulled USA Today, both of them spitting out pure propaganda about the monetary policy. Absolutely incorrect, had no clue, misguiding everybody who had ever read those two articles. They were completely lost after that. They read those things and they became stupid, right? And it was sad to think, but that's the way that most of the mainstream media is conducting themselves when it comes to talking about the monetary policy. It's sad, right? Monetary policy should be understood from the neutral interest rate issues that they were facing, and that neutral interest rate was too low, and that it was too low due to a inflation expectation and an inflationary scenario that was persistently too low rather than too high. Knowing that the Federal Reserve was conducting themselves in a way that then provided the economy with a higher inflation and a higher inflation expectation, which starts to raise the neutral interest rate, is the way that the Federal Reserve gets their ammo back. That is what they needed in order to save themselves. And everybody seems to think that they are doing something like they failed at what they were doing or something. It's like, to me, they are conducting themselves exactly in the way that they needed to do in order to make sure that they maintain their own existence. And everybody fell into it and saved them. By having an inflation expectation that was extremely elevated, it rescued the Federal Reserve. Like, everybody who believes that they effed up and that they don't know what they're doing and that they screwed up and that inflation was going to be running persistent into the future, saved the Federal Reserve's monetary policy. It did exactly the opposite of what they were either hoping for or believing was going to occur. But that actually saved them in their monetary policy. And it's continuing to save them even today. All right. Come back for the live stream tonight. I'll leave a link down in the, I'll leave a link down in the description for it. But ultimately, there is a join the membership channel, and then I will also schedule a live stream for 6 o'clock tonight, Pacific time, Western time here, West Coast time. And we're going to be covering Michelle Bowman's speech, talking about balance sheet adjustments to conduct monetary policy. So Anyway, going to be a really good speech, really, break down how it is that the Federal Reserve is conducting themselves in the real way, not the idea of interest rate adjustments, which is BS. So understanding how the Federal Reserve's monetary policy is going to work through the balance sheet adjustments is going to be, discussed tonight on this channel. Membership only, though. It's going to cost you $1 to join in, so it doesn't really cost you anything, but it's everything to me. I put a lot of work and time and effort into these things. So, all right. That's enough for the promotion. Uneducated Economist, you guys let me know.